Institutional Equity Research Report, NASDAQ, NAVITS, Navitas Semiconductor Corp., a tiny revenue GaN/SiC chip maker, bets its future on AI data center power.
Section 1. Executive Summary. Navitas Semiconductor Corp. is a Torrance, California-based power semiconductor company that designs gallium nitride, GaN, and silicon carbide chips used to convert and manage electrical power more efficiently than traditional silicon components. The company went public in October 2021 through a merger with special purpose acquisition company Live Oak Acquisition Corp. II, and has spent the past several years transforming itself from a GaN-focused fast charger chip supplier for phones and laptops into what management calls Navitas 2.0, a company almost entirely focused on high-power markets, AI data centers, electrical grid and energy infrastructure, performance computing, and industrial electrification. In plain terms, gallium nitride and silicon carbide are materials that let power chips run faster, cooler, and more efficiently than traditional silicon, which matters enormously as AI data centers consume increasing amounts of electricity and need to convert that power from the grid down through several voltage stages to the chips themselves as efficiently as possible. Navitas is betting its entire future on becoming a critical supplier of that power conversion technology to AI infrastructure builders, walking away from its original, much smaller consumer electronics business, mobile phone and laptop chargers, almost entirely in the process. The company remains very small by revenue, just $10.5 million in the most recent quarter, but it is exceptionally well-funded relative to its size, having raised $373 million in new equity during the second quarter of 2026 alone, bringing total cash to $557.4 million. That's a striking amount of capital for a company generating roughly $40 to $50 million of annualized revenue, and it reflects intense enthusiasm for the AI power semiconductor theme, even as the stock itself has proven extremely volatile, falling roughly 40% in the month before its Q2 2026 earnings report, after having been up more than 50% year-to-date at an earlier point. Key facts at a glance. Core technology: GaN-fast gallium nitride power ICs, and GaN SiC high-voltage silicon carbide devices. Strategic pivot: Navitas 2.0, exiting mobile and consumer, focusing almost exclusively on AI data centers, grid and energy infrastructure, performance computing, and industrial electrification. Q2 2026 revenue: $10.5 million. Plus 22% sequentially. High-power markets grew more than 50% year-over-year. Q2 2026 GAAP net loss: minus $228.2 million, driven overwhelmingly by a $203.1 million non-cash earnout remeasurement charge. Cash position: $557.4 million, after a $373 million equity raise during Q2 2026. Legal overhang: patent infringement lawsuit filed by Wolfspeed, July 2026, also facing Renesas litigation.
Q3 2026 guidance. Revenue of $13.5 million plus $0.5 million plus 28% sequential. Non-GAAP gross margin 39.7% plus 100 bps. This report is intended to give both professional and retail investors a clear-eyed, plain English view of Navitas's business, its most recent quarterly results, and the key risks and catalysts likely to matter over the next 12 to 24 months. It is not a recommendation to buy, sell, or hold NVTS shares. Section 2. Investment thesis. The bull case for Navitas is that it sits at the intersection of two of the most talked-about themes in technology investing today: AI infrastructure build-out and the transition to wide bandgap GaN and SiC power semiconductors. High-power market revenue grew more than 50% year-over-year in the most recent quarter, Management expects AI data center and grid/energy revenue to exceed 1/3 of total sales by the end of 2026, and the company has secured tangible validation points, an expanded NVIDIA MGX ecosystem collaboration, a global foundries manufacturing partnership, and a new Magnachip strategic partnership, while Wolfspeed's 2025 Chapter 11 bankruptcy has arguably left a competitive vacuum in the SiC market that Navitas is positioned to help fill. The company's massive $557.4 million cash balance, raised opportunistically during a period of strong investor demand, gives it years of runway to execute this pivot without near-term financing risk. The bear case is equally stark. This is a company with roughly $40 to $50 million of annualized revenue, trading at a valuation independent analysis has pegged at approximately 66 times sales, an extraordinarily rich multiple that leaves essentially no room for execution missteps. The company remains deeply unprofitable on an operating basis, $11.4 million operating loss in Q2 2026 alone, is currently being sued by competitor Wolfspeed over AI chip patents, and its entire growth narrative depends on the pace and shape of AI data centers adopting new, higher voltage, 800-volt power architectures, a transition management itself describes as happening in stages, with real uncertainty about timing. The stock's extreme volatility, down -40% in the month before Q2 earnings after being up more than 50% year-to-date, reflects a market still trying to figure out how to value a story this speculative. Thesis in one sentence. Navitas offers direct, well-capitalized exposure to the AI data center power semiconductor theme through a genuine technology pivot already showing revenue traction, but at a nosebleed valuation multiple on a still tiny revenue base, facing active patent litigation, and its entire growth narrative depends on the pace and shape of AI data centers adopting new, higher voltage, 800-volt power architectures, a transition management itself describes as happening in stages, with real uncertainty about timing. Section 3. Company Overview. Legal Entity. Headquarters. Exchange/ticker. Founded. Public listing. President and CEO. Key technologies. Early investors. Navitas Semiconductor Corporation. Torrance, California. NASDAQ/NVTS. 2014. October 2021 via SPAC merger with Live Oak Acquisition Corp. II. Approximately $1 billion enterprise value. Approximately $320 million net cash to Navitas. Chris Alexandro. GaNFast, gallium nitride power ICs for consumer fast charging. GaN SiC, high voltage silicon carbide. Live Oak Acquisition Corp. II, Atlantic Bridge Capital, Xiaomi, Capricorn Investment Group. Corporate milestones. Date: Milestone 2014. Navitas Semiconductor founded, initially focused on GaN power ICs for consumer fast charging. October 2021, becomes publicly traded via SPAC merger with Live Oak Acquisition Corp. II, raising approximately $320 million in net cash. July 2022, acquires GaN SiC Semiconductor, adding high-voltage silicon carbide capability and expanding into EV, solar, energy storage, and industrial applications. 2025 to 2026, launches Navitas 2.0 strategic pivot, deliberately winding down mobile and low-end consumer revenue to focus almost exclusively on AI data center, grid/energy, and industrial electrification markets. December 2025. Partners with Science Semiconductors to accelerate GaN adoption in India, supporting the Make in India Semiconductor Initiative. May 26, 2026.
Navitas stock jumps approximately 24% on India GaN partnership news, briefly pushing market value near $5.2 billion. July 8, 2026. Navitas responds to a patent infringement complaint filed by Wolfspeed related to AI chip technology. July 23, 2026. Announces strategic partnership with Magnachip to accelerate high-voltage and ultra-high-voltage silicon carbide adoption.
Section 4. Business Model. Navitas is a fabless semiconductor design company. It designs GaN and SiC power chips in-house, but outsources actual manufacturing to third-party semiconductor foundries, including a partnership with Global Foundries for next-generation 8-inch GaN production, a common and capital-efficient structure in the chip industry that avoids the enormous cost of building and operating its own fabrication facilities. Revenue is generated by selling these chips to electronics manufacturers and increasingly to AI infrastructure and data center power system builders who integrate Navitas's components into their own finished products. The company's business model is currently undergoing a deliberate, management-directed transformation. Rather than pursuing revenue wherever it can be found, Navitas is actively exiting its historical mobile and low-end consumer electronics business, fast chargers for phones and laptops, a decision that has temporarily suppressed total reported revenue growth, even as the higher power, higher value segments of the business, AI data centers, grid, and energy, industrial, grow rapidly. This is a genuine strategic bet that a smaller, more focused, higher average selling price business will ultimately be more valuable than a larger but lower margin, more commoditized consumer electronics supplier. How to think about it? Navitas is deliberately shrinking part of its business to grow a different, more strategically valuable part faster, which is why the company's total revenue figures can look confusing at first glance, declining year over year even as management describes strong growth, until you separate out the legacy consumer business being wound down from the high-power business being built up. Section 5. Products and Services. Navitas's core GaN power line integrates a gallium nitride power transistor, gate driver, and control sensing protection logic onto a single monolithic chip, replacing what would otherwise require multiple separate silicon components. This integration enables faster switching speeds, higher power density, smaller, lighter power supplies, and greater energy efficiency than traditional silicon designs, historically used in mobile phone and laptop fast chargers, and now increasingly targeted at AI data center power supplies and onboard EV chargers. GaN SiC high-voltage silicon carbide. Acquired via the 2022 GaN SiC deal, this product line uses patented trench-assisted planar technology to deliver high-voltage capability, efficiency, and reliability for medium-voltage grid and industrial infrastructure applications, complementing GaN's strengths at somewhat lower voltage and power levels, with 6 advantages and higher voltages, roughly 1,000 volts and above, which is particularly relevant to electric vehicle powertrains and grid-scale energy applications. AI infrastructure-specific developments. Navitas has expanded its collaboration with the NVIDIA MGX ecosystem, demonstrating an 800-volt to 6-volt DC-to-DC power conversion board specifically designed for next-generation AI data center architectures, addressing the multi-stage power conversion challenge of stepping electricity down from high-voltage grid or facility-level distribution to the low voltages actual AI chips require. The company also introduced an isolated TO SiC product family and a 1.2 kV JFET product line targeting AI and grid markets, alongside plans for a third-generation 6.5 kV SiC technology release in Q3 2026 and a 1.2 kV JFET product line in early 2027. How to think about it? Think of Navitas's product roadmap as chasing the entire power conversion chain inside an AI data center, from grid-level high voltage
all the way down to the low voltages individual AI chips need, using GaN and SiC technology at each stage where it offers an efficiency advantage over traditional silicon. Section 06. Industry Overview. The power semiconductor industry is in the midst of a multi-year transition from traditional silicon-based components toward wide bandgap materials, primarily gallium nitride, GaN, and silicon carbide, that offer meaningfully higher efficiency, switching speed, and power density. While traditional silicon power devices still dominate the broader market today due to their lower cost, GaN and SiC are capturing an increasing share of applications where their efficiency advantages justify a price premium, and industry observers have described this transition as accelerating faster than earlier expected, as AI infrastructure build-out intensifies the need for more efficient power delivery at scale. This industry backdrop has been further reshaped by competitive disruption. Wolfspeed, previously one of the primary pure-play SiC suppliers, filed for Chapter 11 bankruptcy in 2025, and its subsequent restructuring has left what some industry observers describe as a competitive vacuum that Navitas and other players have moved to fill. Even as Wolfspeed has separately pursued patent infringement litigation against Navitas, specifically over AI chip technology, illustrating that competitive and legal dynamics in this space remain very much unsettled. Section 7. Market Opportunity. Navitas has publicly targeted a $3.5 billion serviceable addressable market (SAM) by 2030 across its combined GaN and high-voltage SiC opportunity in AI infrastructure, grid/energy, and industrial electrification. A figure independent analysis has specifically flagged as carrying real execution risk, since achieving it depends heavily on both the pace of 800-volt AI data center architecture adoption and Navitas's ability to convert design engagements into actual production revenue at scale. Management has described the AI infrastructure market opportunity in stages: initial demand for components supporting current architectures, followed by a longer-term transition toward native 800-volt systems that could unlock substantially larger content opportunities per data center as the industry matures. Beyond AI data centers, the broader electrification of transportation, grid modernization, and industrial systems provides additional multi-year demand tailwinds for wide bandgap power semiconductors generally, though Navitas faces genuine competition for share of this broader opportunity from both much larger, better-resourced incumbents and other more narrowly focused wide bandgap specialists. How to think about the opportunity? The $3.5 billion 2030 SAM target is a genuinely large number relative to Navitas's current $40 to $50 million annualized revenue run rate, but it's a target, not a guarantee, and the gap between addressable market and revenue Navitas actually captures will depend entirely on execution over the next several years. Section 8. Competitive Landscape. Competitor. Category. Positioning. Infineon Technologies, GaN and SiC, large diversified. Market leader in traditional silicon-based high-power devices, IGBTs, with growing GaN and SiC portfolios, vastly greater manufacturing scale and automotive relationships than Navitas. Wolfspeed, SiC pure play. Historically, the primary pure-play SiC competitor underwent Chapter 11 bankruptcy restructuring in 2025 and is now actively suing Navitas over AL-chip patents. Power integrations. GaN. Named directly as a GaN competitor in Navitas's own annual filing. ST Microelectronics. SiC, large diversified. Vertically integrated SiC leadership with a broad overall product portfolio, competing against Navitas's more focused design-centric approach. onsemi, Texas Instruments, monolithic power systems. Broader power semiconductors. Large, diversified power semiconductor suppliers competing across multiple end markets Navitas also targets. Innosense, GaN, China.
major Chinese GaN competitor, though geopolitical tensions and IP litigation have limited its expansion into U.S. and European industrial markets. Where Navitas stands. Navitas positions itself as a pure-play specialist in next-generation GaN and SiC materials, without the legacy silicon baggage that independent analysis suggests slows down larger, more diversified competitors like Infineon and ST Microelectronics. Wolfspeed's bankruptcy-driven retrenchment has created a genuine opportunity for Navitas to gain SiC share, though the same disruption has also produced active patent litigation between the two companies. Relative to giants like Infineon and ST Microelectronics, Navitas remains a small design-focused company, reportedly around 160 employees, competing primarily on technology differentiation and speed of innovation rather than manufacturing scale. Section 9. Management Team. Chris Alexander, President and Chief Executive Officer, leads the company's Navitas 2.0 strategic transformation, which he has described as substantially complete as of Q2 2026, with the business increasingly centered on GaN and high-voltage SiC products for AI infrastructure, grid and energy systems, performance computing, and industrial electrification. On the Q2 2026 earnings call, Alexander highlighted that high-power markets grew more than 50% year-over-year and characterized rapid AI adoption as creating accelerated market demand to overcome critical power bottlenecks in AI infrastructure. He has also directly addressed investor questions about the pace of 800V architecture adoption, stating the transition is progressing in steps across multiple GPU platforms, and confirmed no change to the company's 2027 revenue outlook as a result. Section 10. Financial Performance. Metric. Q1 2026. Q2 2026. Revenue. $8.6 million. Plus 18% QOQ, minus 38.7% year-over-year. $10.5 million, plus 22% QOQ, below $14.5 million in Q2 2025. Non-GAAP gross margin, approximately 39.0%, implied. 39.5%. Plus 50 BPS QOQ, plus 100 BPS year-over-year. GAAP operating loss, $27.8 million. $11.4 million. Cash and equivalents, $221.0 million. $557.4 million after $373 million equity raise. Non-GAAP EPS, minus $0.04, beat minus $0.05 estimate. Beat on revenue, missed on EPS, per Investing.com headline. In plain terms, Navitas remains a very small, unprofitable company by traditional metrics, but the underlying trend is one of accelerating sequential revenue growth, plus 18%, then plus 22% quarter-over-quarter, as the high-power pivot gains traction, alongside a dramatically strengthened balance sheet following the $373 million equity raise. The operating loss narrowed meaningfully from Q1 to Q2 despite the revenue growth, suggesting some early operating leverage, even as the company simultaneously plans to increase spending further in Q3 2026 to support continued growth. The $228.2 million GAAP net loss explained. Investors should not mistake Navitas's headline $228.2 million Q2 2026 GAAP net loss for a sign of operational distress. $203.1 million of that loss was driven by a non-cash
earn-out remeasurement charge, an accounting adjustment that increases a liability on the balance sheet when a company's stock price rises and certain contingent performance-based compensation or acquisition-related obligations become more likely to be triggered or more valuable. In plain terms, this large paper loss is arguably a byproduct of the stock's own strong price appreciation during the year-to-date period, up more than 50% at one point, interacting with pre-existing contractual earn-out structures rather than a reflection of deteriorating business fundamentals. The much smaller $11.4 million operating loss is a more representative measure of the company's actual cash operating performance for the quarter.
Section 11. Detailed Analysis Latest Quarterly Earnings Q2 2026. Revenue. Total revenue was $10.5 million, up 22% sequentially from $8.6 million in Q1 2026, beating the company's own guidance midpoint of $10.0 million. High-power markets, AI, data center, grid/energy, and industrial, grew more than 50% year-over-year, offsetting the company's continued, deliberate exit from mobile and low-end consumer applications, which caused total revenue to remain below the $14.5 million reported in Q2 2025. Gross margin. Non-GAAP gross margin was 39.5%, up 50 basis points sequentially and 100 basis points year-over-year, reflecting a favorable mix shift toward higher value, higher power products as the legacy consumer business, typically lower margin, continues shrinking as a share of total revenue. Operating income. GAAP operating loss was $11.4 million, narrowing slightly from the prior quarter despite higher revenue, with operating expenses roughly flat sequentially at $15.5 million versus $15.0 million in Q1 2026. Net income. GAAP net loss was $228.2 million, driven overwhelmingly by the $203.1 million non-cash earn-out remeasurement charge discussed in Section 10, rather than by operating performance. On a non-GAAP basis, the company beat revenue expectations but reportedly missed EPS estimates, per contemporaneous reporting. EPS. Precise standardized GAAP and non-GAAP diluted EPS for Q2 2026. Information not publicly available as a single reconciled figure in the specific sources reviewed for this report, given the significant distortion from the earn-out remeasurement charge. Readers should consult the complete Form 10-Q on SEC EDGAR for the precise calculation. Cash flow and balance sheet. Cash and cash equivalents rose to $557.4 million as of June 30, 2026, up dramatically from $221 million at the end of Q1 2021. This gives Navitas an exceptionally strong balance sheet and multi-year runway relative to its current cash burn rate, though it also represents meaningful dilution to existing shareholders. Guidance. Management guided Q3 2026 revenue to $13.5 million plus $0.5 million, representing approximately 28% sequential growth, with non-GAAP gross margin guided to 39.7% plus or minus 100 basis points. The company also indicated plans to increase quarterly operating expenses by $1 to $1.5 million in Q3 to support research, customer support, and production readiness, while stating this spending increase would remain meaningfully below the pace of revenue growth. Management did not provide formal full-year 2027 guidance, but stated there was no change to its 2027 revenue outlook despite ongoing questions about the pace of 800-volt architecture adoption. Management commentary. CEO Chris Alexandro stated, "Our strong second quarter results and expectations for continued double-digit quarterly growth in the second half of the year demonstrate the increasing traction of our strategic shift to Navitas 2.0 and focus exclusively on high-power markets."
He added that AI adoption is driving accelerated market demand to overcome critical power bottlenecks in AI infrastructure, both within AI data centers as well as the requisite grid and energy infrastructure needed to power them. Key changes versus previous quarter. Sequential revenue growth accelerated slightly, 18% in Q1 to 22% in Q2, with Q3 guidance implying further acceleration to approximately 28%. Cash position increased by more than $336 million quarter over quarter, following the $373 million equity raise, dramatically strengthening the balance sheet. The GAAP operating loss narrowed from $27.8 million in Q1 to $11.4 million in Q2, even as the much larger GAAP net loss figure was driven by the non-cash earnout remeasurement charge. New legal risk emerged with Wolfspeed's patent infringement lawsuit just weeks before the earnings report. New strategic partnership announced with Magnachip for high-voltage and ultra-high-voltage SiC, alongside continued progress on the GlobalFoundries GaN manufacturing transition.
Section 12. Growth Drivers. 1. AI Data Center Power Architecture Transition. Continued adoption of higher voltage, 800-volt AI data center power architectures and Navitas's expanding NVIDIA MGX ecosystem collaboration represent the company's single largest long-term growth opportunity. 2. GlobalFoundries 8-inch GaN manufacturing transition. Full customer sampling and qualification expected before the end of 2026, with initial qualified product in early 2027, potentially improving manufacturing scale, cost, and supply chain resilience. 3. Wolfspeed's competitive retrenchment. Wolfspeed's 2025 bankruptcy restructuring has created a competitive opening in the SiC market that Navitas is positioned to capture, even as the same disruption has produced active patent litigation between the companies. 4. New geographic and partnership expansion. The Cyient Semiconductors partnership targeting India's GaN market and the new Magnachip strategic partnership for high-voltage SiC both represent incremental avenues for revenue and market expansion beyond Navitas's existing customer base. 5. Substantial cash reserves supporting sustained R&D investment. The $557.4 million cash balance provides multi-year runway to fund continued new product development, third-generation 6.5 kV SiC and 1.2 kV JFET lines, without near-term financing risk or dilution pressure. Section 13. Key risks. 4. Extremely rich valuation on a tiny revenue base. Independent analysis has pegged Navitas's valuation at approximately 66 times sales, a multiple that assumes years of successful, uninterrupted execution and leaves essentially no margin for error if growth disappoints or the AI infrastructure transition unfolds more slowly than expected. Active patent litigation from Wolfspeed. Wolfspeed's patent infringement lawsuit over AI chip technology, filed in July 2026, introduces genuine legal and financial risk, including potential damages, injunctions affecting specific product lines, or costly settlement terms. The company also faces separate litigation from Renesas. Continued operating losses. Despite narrowing sequentially, Navitas remains deeply unprofitable on an operating basis, $11.4 million operating loss in Q2 2026 alone, and management has signaled plans to increase operating expenses further in Q3 2026, meaning a clear path to sustained profitability remains a future, not current reality. Uncertain pace of 800-volt AI data center power architectures. The company's own management has acknowledged that the transition to native 800-volt AI data center power architectures is happening in steps across multiple GPU platforms, with genuine uncertainty about the specific timing that could affect when Navitas's largest addressable opportunity actually materializes into revenue. Extreme stock price volatility.
NVTS shares fell approximately 40% in the month preceding Q2 2026, after having been up more than 50% year-to-date at an earlier point, and spiked 24% on a single piece of partnership news in May 2026, a volatility profile that reflects a market still searching for a stable valuation framework for the stock. Declining total revenue year-over-year. Despite strong sequential growth, total revenue remains below year-ago levels, $10.5 million in Q2 2026 versus $14.5 million in Q2 2025, due to the deliberate wind-down of the legacy mobile consumer business, a dynamic investors need to understand carefully rather than reading the year-over-year decline as a simple negative signal. Intense competition from much larger, better-resourced players. Infineon, ST Microelectronics, onsemi, and Texas Instruments all have vastly greater manufacturing scale, financial resources, and existing customer relationships than Navitas, posing a persistent competitive threat as the wide bandgap semiconductor market grows and attracts more investment from incumbents.
4. Significant recent shareholder dilution. The $373 million equity raise completed in Q2 2026, while strengthening the balance sheet, represents meaningful dilution to existing shareholders and reflects the company's continued reliance on external capital markets to fund its cash-burning growth strategy. Section 14. Valuation. Metric. Value. Recent share price, pre-Q2 earnings, around $11.47. Price per sales multiple, around 66 times per independent analysis. Cash and equivalents, $557.4 million. Q2 2026 revenue, $10.5 million. Company's own 2030 SAM target, $3.5 billion. Approximate market cap at May 2026 high, around $22.65 per share, around $5.2 billion. Navitas's valuation is genuinely difficult to anchor using conventional metrics. At roughly 66 times trailing sales, the stock is priced almost entirely on the market's belief in the company's multi-year AI infrastructure growth story, rather than on any current or near-term earnings power. With cash of $557.4 million representing a substantial portion of the company's total market value at various points during 2026, some analysts and investors have specifically framed the stock partly through the lens of its balance sheet strength and optionality, rather than purely as a revenue or earnings multiple story. This is a genuinely speculative valuation profile, and investors should understand that meaningful further stock price moves in either direction are likely to be driven primarily by news flow, design wins, partnership announcements, litigation developments, rather than incremental quarterly financial results alone, given how small the current revenue base remains relative to the market capitalization. Section 15. Upcoming catalysts. Catalyst. Expected timing. Why it matters. Q3 2026 earnings report. Information not publicly available, typically late October. Will test whether the guided 28% sequential revenue growth and margin targets are achieved. Third generation 6.5 kilovolt SiC technology release. Q3 2026. New product launch relevant to grid and industrial customer engagements. Global Frontiers 8-inch GaN full customer sampling/qualification. Before end of 2026. Key manufacturing transition milestone. Initial qualified product expected early 2027. 1.2 kilovolt JFET product line launch. Early 2027. Extends product portfolio further into grid and AI infrastructure applications. Wolfspeed patent litigation developments. Ongoing. Legal outcome could affect specific product lines, damages exposure, or licensing costs. Further NVIDIA MGX ecosystem design wins. Ongoing.
Additional AI infrastructure partnership announcements would validate the core growth thesis. AI data center revenue reaching greater than one-third of total sales, targeted by Q4 2026, a specific, trackable milestone management has set for the pace of its strategic pivot.
Section 16. Long-term outlook. Navitas's long-term outlook depends almost entirely on whether the AI data center power architecture transition unfolds at the pace and scale the company's current valuation implicitly assumes. If 800V architectures gain widespread adoption over the next several years, and Navitas successfully converts its NVIDIA MGX ecosystem collaboration, Global Foundries manufacturing partnership, and expanding product portfolio into meaningful production revenue, the company's stated $3.5 billion 2030 serviceable addressable market target could support substantial multi-year growth from today's tiny $40 to $50 million annualized revenue base. However, this outcome is far from assured. The pace of architecture transitions in the semiconductor industry has historically often taken longer than initial industry excitement suggests. Competition from much larger, better-resourced incumbents remains intense, and the current patent litigation with Wolfspeed introduces genuine near-term uncertainty. Given the stock's already extreme valuation multiple, the market appears to be pricing in a highly successful outcome. Any signs of execution delay, competitive share loss, or slower than expected AI infrastructure power architecture adoption could result in significant valuation compression, independent of the company's underlying long-term technology positioning.
Section 17. Bull Case Summary. Sequential revenue growth continues accelerating as guided, 28% in Q3 2026 and beyond, with AI data center and grid/energy revenue reaching or exceeding management's one-third of sales target by Q4 2026. NVIDIA's MGX ecosystem collaboration converts into meaningful production design wins as 800V architectures gain broader adoption. The Global Foundries GaN manufacturing transition completes successfully, improving cost structure and supply reliability. Navitas prevails in or favorably settles the Wolfspeed patent litigation, and the company continues capturing CIC market share from Wolfspeed's post-bankruptcy retrenchment. In this scenario, Navitas could grow into a substantial share of its targeted $3.5 billion 2030 addressable market, potentially justifying or exceeding its current rich valuation multiple as revenue scales dramatically from today's small base. Section 18. Bear Case Summary. 800V AI data center architecture adoption proceeds more slowly than management's guidance implies, delaying the revenue ramp the market's rich valuation multiple currently assumes. Wolfspeed's patent litigation results in an unfavorable judgment, injunction, or costly settlement that constrains specific product lines. Larger, better capitalized competitors, Infineon, ST Microelectronics, onsemi successfully defend or expand their own share of the AI infrastructure power semiconductor opportunity, limiting Navitas's addressable growth. Continued operating losses require further dilutive capital raises beyond the recent $373 million round, and the stock's extreme volatility continues, with any earnings miss or guidance disappointment triggering a sharp valuation reset given how much of the current 66 times sales multiple already prices in flawless execution. In this scenario, NVTS shares could see significant, sustained downside as the market recalibrates its willingness to pay a premium multiple for a still tiny, still unprofitable revenue base. Section 19. Final Investment Conclusion. Navitas Semiconductor offers investors a genuine, well-capitalized way to gain direct exposure to the AI data center power semiconductor theme, backed by real, accelerating sequential revenue growth, tangible partnership validation, NVIDIA MGX ecosystem, global foundries, Magnachip, and a fortress-like $557.4 million cash balance that removes near-term financing risk from the investment equation. The company's deliberate strategic pivot away from lower-margin consumer electronics toward high-power AI, grid, and industrial applications is already showing up in improving gross margins and accelerating high-power segment growth. At the same time, investors need to be honest about what they're actually paying for. A company generating roughly $50 million of annualized revenue, trading at approximately 66 times sales, a valuation that leaves essentially no room for the kind of execution delays or competitive setbacks that are common, not exceptional, in semiconductor industry transitions. Active patent litigation from Wolfspeed adds a further layer of near-term uncertainty, and the stock's demonstrated extreme volatility, swinging by double-digit percentages on single news events, reflects a market that has not yet found a stable way to value this story. Bottom line, Navitas Semiconductor is best understood as a high-risk, high-potential reward thematic bet on the AI infrastructure power semiconductor transition, well-funded and showing genuine early commercial traction, but priced for a level of success that remains entirely unproven at the company's current tiny revenue scale. This report does not constitute a recommendation to buy, sell, or hold NVTS shares. Readers should review the company's complete SEC filings and consult a qualified financial advisor before making any investment decision.